Okay, let's just dive in. If you are looking at your portfolio today, and I mean today, Monday, February 2nd, 2026, you might want to just close the app.
Go for a walk. Don't look.
Seriously, it is a sea of red, and not just a little correction. We're seeing numbers that, frankly, make you think the data feed is broken.
It's historic. I've been watching the terminal all morning, and, there's really no other word for it. This is the kind of move you see maybe once a generation.
We have to list these numbers out because just saying market crash doesn't do it justice. We're talking silver, crashing 36%.
36.
It's around $83 an ounce. Gold has plummeted 13%. That's a $900 drop in one day.
And that's supposed to be the safe asset.
Right, and Bitcoin. It blew right through that key support at 86,000. It's now hovering around 78K. That's what, over $110 billion gone in
And
24 hours.
Exactly. And when you see moves like that magnitude across things that shouldn't be related, metals, crypto, stocks,
Yeah.
you have to stop using the normal words.
So it's not a correction.
No, this is not a correction. This is what we call a liquidation event.
A liquidation event. Okay, that sounds ominous. Break that down. How is that different from just a really, really bad day on Wall Street?
It's a huge distinction.
Yeah.
A correction, that happens when investors decide something's overvalued. They sell because they want to.
They're changing their minds.
A liquidation event is different. People aren't selling because they want to. They're selling because they have to. It's a forced sale. Everyone rushing for the same small exit all at once to get cash.
It's the difference between a garage sale and a foreclosure.
That is a perfect way to put it. It's systemic. It's forced.
But here's the part I can't wrap my head around, the core mystery. When things get scary, and we'll get to just how scary they are, people run to gold, right?
That's the playbook.
So why is the ultimate fear trade crashing when fear is maybe at an all-time high?
That is the multi-billion-dollar question, isn't it? And the answer, it's complicated, but it boils down to what I'd call a two-tier reality. To really get it, we have to look at a banking crisis that's hiding in plain sight, a completely paradoxical new Fed policy, and this massive split between paper price and physical stuff.
Okay, let's start there. The two-tier reality. Because my screen says $83 silver. Last week, that would have been a steal. My gut says buy now. Is this the opportunity of a lifetime?
Well, this is where things get, a little weird and honestly a little scary. You're looking at the paper price.
The screen price.
Right, what traders are selling contracts for.
Yeah.
But that crash, that wasn't millions of people selling their coins. It was triggered by massive dark pool sell orders.
Dark pools. So not retail investors. We're talking the big fish.
The biggest, huge algorithmic sell orders that hit the market and just started a domino effect of margin calls.
Leverage.
So much leverage. You have all these traders borrowing money to bet on higher prices. The price ticks down just a little, and boom, the phone rings. It's the broker.
You need more cash. Right now.
And in a liquidity crunch like this, they don't have it. So the computers just take over. They automatically sell everything to cover the debt. It's a mechanical, computer-driven waterfall.
So it has nothing to do with the value of an ounce of silver. It's about the solvency of the guy who bet on it.
Precisely.
Okay, so it's a paper-driven fire sale, but the disconnect, I still don't get it. If I see $83, I should be able to buy it for $83.
You would think so, but I dare you to try. Go try and buy a physical American Silver Eagle coin for that price right now.
You can't.
You can't.
Why? Is inventory just wiped out?
Worse, we're getting confirmed reports. The U.S. Mint has suspended production of 2026 Silver Eagles.
Wait, what?
They're citing scarcity of these silver blanks they use to mint the coins.
The Mint stopped making money. That feels like a headline that should be a little bigger than a stock crash.
For their main bullion product, yes. So here's the twist. The street price, what you actually pay to get the metal in your hand, has completely decoupled from the market price.
So spot is 83 on my screen.
But the street price is holding firm, somewhere near $100.
That's almost a 20% premium just to hold it.
It's unprecedented. A spread like that tells you the paper market is broken. It's not reflecting physical reality anymore. The price discovery mechanism is just gone.
The old saying, if you don't hold it, you don't own it.
It's not a cliche anymore. It's a legal warning. And look, it's not just the U.S. Look at China. A major gold exchange in Shenzhen has blocked withdrawals.
Blocked withdrawals, that's a bank run, but for gold.
That's exactly what it is. We're talking somewhere between, $1.4 and $19 billion at risk. They're telling their customers, sorry, the gold you thought you had, it's not here. People owned a digital IOU, not metal.
And when everyone wanted the metal at once, the vault was empty.
The cupboards were bare. It signals a potential global failure of these paper markets.
Okay, so paper is crashing, physical is disappearing, that's the disconnect. But let's go back to the trigger. You said liquidation event, a forced sale. Who is being forced and why do they need cash so badly today?
Right. This brings us to the canary in the coal mine. Did you see the news about Metropolitan Capital Bank this morning?
I did, yeah. Regulator seized it. But, being honest,
Mm.
it's a small bank, right? 261 million in assets. Why does a small bank failing cause this huge ripple?
It matters because of why it failed. This isn't a one-off, it's the first domino. It failed because of its exposure to commercial real estate, CRE.
Ah, the empty office buildings. We've been hearing about this for years. It's felt a bit like the boy who cried wolf.
Well, the wolf is here, and he's big. It's a $1.5 trillion crisis waiting to happen. Our source data shows nearly 2,000 U.S. banks
2,000.
have CRE exposure greater than 300% of their total equity.
300%. So if their real estate loans drop in value even a bit, the bank it's just gone.
Wiped out. They're technically insolvent. You have falling property values smashing right into these refinancing walls.
Right. The loans from 5 years ago at 2% are coming due.
And they have to be refinanced at 7 or 8%. The buildings don't make enough rent to cover the new payment. The banks can't afford the loss. It's a standoff.
Okay, so connect the dots for me. Bank in Ohio is in trouble over an office building. How does that make Bitcoin fall $10,000 in New York?
Liquidity. The other banks, the big institutions, they know they have the same toxic CRE loans on their books. They see Metropolitan Capital go down, and they think, we're next.
So they need cash, fast.
Desperately, to plug the holes before regulators start asking questions. And you can't sell an office tower in an afternoon, but what can you sell in a microsecond?
Gold, silver, Bitcoin, stocks, whatever's liquid.
Exactly. They're not selling crypto because they suddenly hate it. They're selling it because it's the only thing they can sell. They're selling the good assets to cover the bad debts. That is the definition of a liquidation event.
That's a terrifying picture. It makes it sound like the entire regional banking system is just teetering. But where is the Fed? The Federal Reserve has to see this.
You'd think so.
Usually they step in, right? The Fed they lower rates, print money, save the day. What's different now?
This is the third piece of the puzzle.
Mm-hmm.
And it's maybe the most confusing part for the market. We have a huge leadership change coming. Kevin Warsh is the nominee for the next Fed chair. He takes over in May.
Okay, new guy, Warsh. Is he signaling a big strategy shift?
A radical one.
Right.
And the market is basically having a seizure trying to figure it out. Warsh is proposing a paradox. On one hand, aggressive rate cuts.
Okay, market likes that. Keep money, stocks go up.
Usually, he wants to cut rates to bail out government debt, help consumers. But, and this is a huge bidder, but at the same time, he's calling for continued quantitative tightening, QT.
Wait a second. Rate cuts pump money in, QT pulls money out. He wants to do both at the same time.
Exactly. Imagine you're in a car. He wants to slam on the accelerator and the brake hard
Yeah.
at the same time.
Yep. That sounds like a recipe for blowing the engine, or at least giving everyone whiplash.
And that's what's happening. The market is reacting to this Warsh reset with total confusion. Capital is rotating violently. Investors are dumping inflation hedges gold, crypto, because they fear the QT, the break.
The liquidity drain.
Right. But they're piling into stocks to chase the promise of cheap rates from the rate cuts, the accelerator.
So they're dumping safety to gamble in the stock market casino, all while the banks are quietly on fire in the background.
It's a massive bet. And it totally ignores what's happening on Main Street in the real economy.
Right, because away from the charts, people still have jobs to go to, or maybe not.
Yeah.
What are the reports you pulled saying about that?
It's what some are calling a reverse boom. It's stagflation. Look at manufacturing. The U.S. has lost 72,000 manufacturing jobs just since last April.
72,000 in the sector we're supposedly protecting.
And it's big names. Oracle is cutting 30,000 staff.
Yeah.
Volkswagen is canceling entire factories. These are huge structural cuts.
And I saw that trade deficit number. It exploded.
Up almost 95%
Yeah.
to a 30-year high. It shows that right now, our protectionist policies are hurting our exports more than they're helping.
Yeah.
And the real kicker, inflation is coming back. The producer price index just jumped 0.5%.
Let me get this straight. We're losing jobs. Big companies are shrinking. but the price of everything is still going up.
That's the textbook definition of stagflation. Worst of both worlds.
Okay, so banking crisis, Fed confusion, stagflation. And as if that's not enough for one Monday, we have to talk about the geopolitics, the war drums.
This is the wild card, the external threat. We have confirmation that a U.S. armada is moving toward Iran. The quote was, with speed and purpose.
Speed and purpose. That is not the language of a routine exercise.
No. Analysts are openly warning of a potential strike over the weekend.
Yeah.
Now think about the irony.
Okay.
Normally, if war is coming, what happens to oil and gold?
They spike, they go vertical. Ultimate uncertainty hedges.
Exactly. But because of this liquidation event, because everyone needs cash right now, they're being sold off. They're being suppressed temporarily, despite the massive war risk.
That's insane. It's like selling your fire insurance policy to pay your water bill just as you see smoke coming from the attic.
You are totally exposed, and the rest of the world sees it. This instability is causing real isolation. We're seeing a new SA boycott trend spreading in Canada and the UK.
People are actually using apps to avoid buying American products.
It's a cultural shift, and it's happening at the institutional level too. Japanese and European pension funds are dumping U.S. treasuries. They're citing unpredictable U.S. policy.
So they're just getting out.
They're getting out.
Yeah.
They don't trust the Fed's strategy. They don't trust the military moves. And when trust goes, liquidity goes. It all comes back to that.
Okay. Let's try to tie this all together for everyone listening. It's a lot. We have banks failing, a confused Fed, a recession on Main Street, and a potential war over the weekend.
And through it all, the so-called safe assets are crashing on paper because of forced selling to raise cash.
It's a perfect storm. So what's the single most important takeaway from all this for the person sitting here looking at this mess?
The takeaway is the lesson of the street price versus the screen price. We've hit a point where the price you see on your phone, it might as well be fiction.
How can a price be fiction if it says $83, it's $83?
Only if you can actually buy or sell at that price. If the buy button is grayed out, if there's no inventory because the U.S. Mint shut down production, then the price is meaningless. Access is everything in a crisis.
So the disconnect between the financial economy and the physical economy is now total.
It is. Relying on the numbers on a screen to measure your safety is a huge mistake right now.
That's a sobering thought. We're so used to just clicking a button and assuming the transaction will happen.
And that assumption might not hold. We're moving into an era of friction, scarcity, where physical possession is all that matters.
Okay, before we go, leave us with a final thought. We've got this weekend coming up, markets closed, armada moving. What should we be thinking about?
I want you to just think about this. The Mint has suspended production. A war could start over the weekend. If you're waiting for the paper price to hit some perfect bottom before you act, you're playing a very dangerous game.
Because by Monday morning...
By Monday morning, if things go badly, the price of safety might be infinite.
Infinite, as in you just can't get it at any price.
Exactly. Don't trust the digital ticker. Trust what you can actually hold in your hand.
Wow, okay. That is a heavy place to end, but I think it's the reality check we all need. It's not just about the numbers. Stay safe out there, everyone. We will be tracking this all week. Thanks for listening to The Deep Dive.